Hello everyone, welcome to the webinar. We will be discussing the continuation and reversal patterns, distinguishing the bullish and bearish ones in the process. This webinar aims to help participants master pattern in the trading market and to trace it while in process of decision making. It's very important to know the materials and tips provided within this webinar save you big losses and years of misery. At the same time, it helps you advance your trading journey and elevate you significantly and rapidly. For the continuation patterns, the continuation patterns suggest that after a temporary pause or consolidation in the price movement, the prevailing trend is likely to resume. These patterns indicate a temporary break in the trend, allowing the price to consolidate before continuing in the same direction as the original trend. Traders typically view continuation patterns as signals that the ongoing trend will persist. Examples of continuation patterns include flags and pennants. These patterns form after a sharp price movement, the flag pole, followed by a period of consolidation, the flag or pennant, indicating a temporary pause before the trend continues. So in this figure, we can see some flags and pennants. The flags and pennants help you predict the price movement typically. You can see, for instance, in the first figure with the bullish flag pattern, the price started with an uptrend and the flag formed. It's like a bit of a correction, a small correction. However, the bullish trend after this correction will pursue. The same matter happens with a bullish pennant pattern. However, the difference is that the correction on two sides in the flag pattern are parallel. You have also a bullish falling wedge, a bearish flag pattern, a bearish pennant pattern, and a bearish rising wedge. Another example of continuation patterns includes the ascending and descending triangles. These are characterized by a series of higher lows and relatively constant highs, ascending triangle, or lower highs and relatively constant lows, descending triangle. They suggest a potential continuation of the previous trend. For example, we have the symmetrical triangle, the ascending triangle, and the descending triangle. You see the trend continues. For instance, if we start with the bullish trend, the symmetrical triangle forms and it pursues a bullish trend. And same way in other scenarios. For the bullish patterns, they appear during an uptrend, and bearish patterns appear during downtrends. However, a bearish reversal will be seen during a bullish trend, as it is suggesting we are about to change from bullish to bearish. So a bullish reversal will appear during a downtrend. You can employ the Japanese candlesticks, for instance, to assess the reversal patterns. You can see in the figure you have the engulfing. For instance, you had a small bearish candle, red one, followed by a much bigger green candle, suggesting an engulfing pattern, and the market price reversed to pursue the bullish trend. Another example is the dragonfly doji, in which you can see you should memorize the candle shapes. For instance, in the dragonfly doji, you see that a much liquidity was put into the market, reversing from a bearish downtrend to a bullish uptrend. For the trends and patterns, you can refer to lesson 1, trends, to learn how to identify a trend. Once a trend has been established, or at least a suspected trend, you are statistically more likely to find a continuation pattern on a time frame below the one you have identified a trend on. Whilst every trend will have a reversal at some point, remember that you are statistically less likely to identify the end of a trend. Seek reversal signals on lower time frames that trade in the direction of the higher time frame. So how do we confirm a pattern? There are several methods. and it is down to personal preference as to how you decide to confirm your patterns. However, please be warned that the word confirmation can be a little misleading, as just because we confirm a pattern, it does not guarantee that the pattern will be fulfilled. Confirmation simply means a point on the chart in which we assume when crossed the pattern may reach a target. We're just increasing our probability. For the pattern breakout, in a breakout we simply require a price to cross the line, as you see in the figure. This is an ideal method if you want to set pending orders to catch the breakout. However, price can and does return over the breakout line to invalidate the pattern. Close. We want to see price close a bar over the line to confirm the signal. This provides extra confidence and reduces the chances of it being a failed signal. However, you also risk the missing the move and for price to take off without you. For the multiple closes, some analysts use 2 or 3 closes to confirm the pattern. Whilst this provides even greater confidence, you again risk the chance of missing the move for it to be profitable enough for your own reward and risk ratio. Throwback. A throwback is typically my preferred style when trading as a pattern. This is where the price breakouts or closes to confirm the pattern, but then returns to the breakout line. If this level then holds as either support or resistance, it can provide an excellent entry with greater confidence and precision to achieve a much better risk to reward ratio. However, the downside to this approach is you are much more likely to repeatedly miss moves if it doesn't quite turn to the breakout line. For the reversal patterns, I'm sure you have heard of the saying buy low and sell high. It sounds simple enough, but attempting to do this is far harder than it sounds. I have observed how most newer traders become fixated on trading reversals in an attempt to get into that trade of a lifetime before everyone else. I have also observed how these same traders tend to lack the ability to stay in a trade once they have entered. This may be because they traded against a string trend, or the occasions they are in profit they move their stop loss too soon, so get stopped out anyway. For the double, triple tops and bottoms, they can be difficult to trade because, much like flags and pennants, they are often very messy. Good for observational purposes and targets, act as a good warning that the trend is losing strength due to the lower high-low, easier to enter after a breakout. You can see the double bottom in a bullish, reflecting the price, how it will increase, and how you can predict the price movement by drawing an arrow from the bottom to the neck and copying and pasting the same arrow at the end of it, and vice versa for the double top, for the bearish movement. The concept is very similar to support and resistance. At any one time, market participants have one of 3 choices to buy, sell, or stand aside. As this ratio between the 3 groups changes over time, so does the supply and demand for any given market. As this force changes, so does the price. This is all based upon participants and groups of opinions of where the price should be. As the battle towards the correct market price unfolds, we see trends and oscillations develop, which when combined form familiar patterns. I would like to thank you for your attendance. We have certainly provided valuable information that you can practically employ for your trading. Additionally, we provided some valuable information to add to your knowledge. I hope you stay tuned for more. Thank you.